What do you know about the Federal Reserve?
Not much.
There is this perception that people have that the Fed is this kind of black box. Nobody quite understands it.
Take care of currency?
Where something about money.
They somehow regulate the stock market.
I think we're mysterious to people. I think they're not sure what we do.
Sounds like they're printing money. Nuh-uh.
One myth that's out there is that what we're doing is printing money. We're not printing money.
Is that tax money that the Fed is spending?
It's not tax money. It's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively.
What exactly is the Fed's job? It does control the money supply, set interest rates, regulate banks, and is supposed to ensure the safety and soundness of the financial system.
The Fed is supposed to be the guardian of financial stability, preventing chaos in markets. Now, usually it can do that. In the summer of 2008, it couldn't do that, and we did get chaos.
But what caused the crisis in the first place? What brought the wealthiest nation in history to its knees? According to many economists and senior Fed officials, it was the Fed itself at the eye of the storm.
I'm on record as saying that I thought the Fed kept interest rates too low for too long.
That contributed to the bubble in housing prices. This was warned about at the time. This was textbook. When you take rates that low, you're going to have a boom, and a bust is likely to follow.
The Fed failed to prevent the housing bubble, the predatory lending scandal, and utterly failed to prevent the financial crisis.
So we failed to regulate the most important part of our financial system.
And I don't think any of us who've ever worked at the Fed take any comfort from the fact that somebody screwed up. But I think it's important we recognize there were some big mistakes made.
Didn't the Federal Reserve System fail?
I know my time has run out, but I really fundamentally disagree with your point of view.
An economist with no prior banking experience had become the maestro.
Looks like I picked the wrong week to quit amphetamines.
Bubbles generally are perceptible only after the fact. To spot a bubble in advance requires a judgment that hundreds of thousands of informed investors have it all wrong.
Looks like I picked the wrong week to quit sniffing glue.
Mr. Chairman, do you see similarities between today's market and what you saw back in the late 90s?
Very little. There is no irrational exuberance that I can see. In fact, it's the opposite at this particular stage. Nonetheless, we still have got a situation in which risk premiums are not all that out of line, and I would not be surprised to see stock prices rising, but not in any pace that could be termed irrationally exuberance-driven.
Okay, that's it. That's good to know. But at the
coming in too fast. Watch your speed. He's coming right at us.
Famously used the term irrational exuberance to describe the bullish sentiment that was driving up stock prices during the dot-com bubble. I believe you used the term in 1996 in a speech. Do you see any signs of irrational exuberance in asset prices today?
Well, let me put it to you this way. I think there are two bubbles. We have a stock market bubble and we have a bond market bubble. I think in the end of the day, the bond market bubble will eventually be the critical issue. But for the short term, it's not too bad, but we're working obviously towards a major increase in long-term interest rates. And that has a very important impact, as you know, on the whole structure of the economy.
First of all, nobody should ever be deified because none of us is God. That did happen to Greenspan. And one corollary of deification is people think you know, and people think you'll always get it right. The concrete manifestation of that inside the Federal Reserve is that it became very hard to criticize Greenspan in any way. I mean, who wants to stand up to God?
The Great Moderation began as an homage to the free market, but today it could not be further from that ideal. The two chairmen, appointed by both Republican and Democratic presidents, created an economy more centrally planned than ever in our history. One entirely dependent on ever cheaper credit from our central bank.
From 20% to zero, drops in interest rates bailed out investors in any number of transactions. Every time the response is more debt fueling growth.
But while this mountain of debt provided rocket fuel for housing and finance, overall growth actually slowed. As more of our resources and many of our best minds pursued not medicine nor engineering, but the zero-sum game of financial speculation.
Creating financial transactions is not production. It does nothing to your standard of living, except for a few people who are able to work at a bank, watch their stock price go up, sell the stock, and then they have the wealth. But they have to sell the stock in order to do it.
You want this roll, nigga? You're gonna have to shoot me.
Stocks got to just astronomical levels. People were forming new companies without any business plans, and investors were giving them money and say, build your website, build your reputation, we don't care, the faster you spend it, the better. I mean, it was absolutely ridiculous.
We were worried about that at the Fed, and we talked about it a lot. Should we raise interest rates in an attempt to prick the bubble before it got too bad, or not? And we decided not.
In other words, the market's efficient, despite the fact that I'm manipulating it. So he let it go.
It was only the June meeting from 1999 where everybody looked around at each other and said, this is unsustainable. There was a unanimous agreement this was not going to end well. And then people said, well, I guess what we should do is just move interest rates up gently and wait for the bubble to burst. This is something I think the general public doesn't really realize. When times are good and equity prices are moving up, people want to believe prices, whether they're in housing or equity, when they're on their way up because the general public has a feeling of buoyancy, of optimism. Some might say delusion.
So the Fed kept filling up the punch bowl. And as opposed to going into inflation of goods prices, it went into an inflation of asset prices. That's inflation in the same way, but it's not called inflation. So if the stock market goes up and doubles, we don't say, oh my God, there's been inflation. Or if housing prices double, we don't say, oh my God, there's been this enormous inflation. We say, oh, how much richer we are. But the problem is, we're not richer. It's simply an illusion of richness.
Oh! Stop! Okay, keep doing it. Yeah!
By the time the 1990s had rolled around, inflation of things, inflation of the checkout counter, was rather receding memory. But it was succeeded by a kind of inflation that we have learned to call asset inflation. That is, prices not of goods going up, but of stocks, bonds, real estate, and other investment assets going up. On Wall Street, that is known as a bull market, and everyone is for it.
We've never had in this country a period when the stock market was going up 15% a year for a sustained period of time, and people thought that was going to continue.
Everybody loves a boom. Who's there who dislikes it?
But Greenspan was concerned that the boom was really a bubble. So he raised a red flag.
In 1996, Alan Greenspan gave a speech and characteristically multi-syllabic formulation. He didn't say, is this market crazy? No. Might there not be irrational exuberance?
How do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions, as they have in Japan over the past decade?
We were worried about that at the Fed, and we talked about it a lot. Should we raise interest rates in an attempt to prick the bubble before it got too bad, or not? And we decided not.
One earlier Fed chairman famously said, the role of the Fed is to take away the punch bowl just when the party gets rolling. Alan Greenspan's attitude was 180 degrees away from that.
Greenspan came to the idea that the Fed could not identify a bubble as it was inflating.
Now, many of us would disagree with that rather vigorously.
It couldn't identify, really, if the market had gotten ahead of itself or was too high, let alone whether it was crazy.
So the role of the Fed is simply to wait till the bubble breaks and then pick up the pieces.
While bubbles that burst are scarcely benign, the consequences need not be catastrophic for the economy.
That was Greenspan's view, and it has been subsequently ravaged by experience. The Fed has no such power.
Like a midget at a urinal, I was going to have to stay on my toes.
3 months after the ball dropped, so did the stock market. The dot-com collapse and 9/11 attacks put to the test Greenspan's view that bubbles could be cleaned up afterwards. And he quickly responded with a series of interest rate cuts to soften the blow.
There was a big fear after 9/11 that we were headed for a huge recession. That didn't happen.
So I think the people who held this view coming through the 2000 bubble collapse felt very vindicated that it was a reasonable approach.
If this is the bust, the boom was sure as hell worth it. You agree with that, right?
Certainly.
It looked like Greenspan had done it again, but there was a catch. The Fed had softened the dot-com crash with aggressive interest rate cuts, and now those same cuts set off another boom.
The Federal Reserve created so much money that it had to go somewhere. We actually found that it was kind of interesting and stimulating to put it into houses.
Lower rates mean lower mortgage payments. The cost of money was less, so the next guy who came along could afford to pay you more, which created an unsustainable bubble in housing.
In today's struggling economy, many Americans have taken refuge by investing in the real estate market.
In Alan Greenspan's case, I think it's important to understand no one but Alan Greenspan had ever engineered what we call a soft landing. That is, you've had interest rates low, the economy's accelerating, you then raise rates, you slow the economy down without letting inflation get out of control or without throwing the economy back into a recession.
So the plane is supposed to come in and just barely touch the ground as it lands. That's what you always shoot for. Usually, you get a bump.
Wait, get this started. It's crashing terrible. Oh my, get out of the way, please. It's bursting into flames and it's falling on the morning baths and all the folks between us. This is terrible. This is one of the worst catastrophes in the world. Oh, it's 400 or 500 feet into the sky. It's a terrific crash, ladies and gentlemen. The smoke and the flames now, and the flame is crashing to the ground, not quite to the mooring mast. All the humanity and all the passengers screaming around it.
The ongoing strength in the housing market has raised concerns about the possible emergence of a bubble in home prices. However, the analogy often made to the building and bursting of a stock price bubble is imperfect. The national housing market is scarcely tender for speculative conflagration.
0% down and we'll give you 10% back.
Ninja loans no income, no jobs, and no assets.
And that was a Ponzi scheme. It was a Ponzi scheme connived in by federal agencies.
We certainly don't want there to be a fine print preventing people from owning their home. We can change the print.
It was the furthest from the Bailey building alone you could possibly get.
American consumers might benefit if lenders provided alternatives to the traditional fixed-rate mortgage.
Feel exactly like I did before I landed on Iwo Jima. I swear to God.
Juice the economy with low interest rates. But far from solving the problem, it would trap the Fed in a vicious cycle from which it is still not escaped.
We took rates down really low. They hadn't been that low for 46 years, and they never stayed that low that long.
By lowering the price of money, the Fed was raising the prices of things bought with borrowed money.
We favored real estate, for example, because we didn't want to see people out of jobs. Well-intentioned, but the consequences are we created the incentives to borrow. And we brought households to debt levels that no one would have imagined 20 years ago, not just 50 years ago.
And when you looked at it that way, you would say, uh-oh. But Greenspan was theory-bound. His theory said you didn't get nationwide recessions in housing.
Japan was a cautionary tale of what can happen when stock market and real estate bubbles explode in a frenzy of speculation, as they did in Tokyo in the 1980s.
Creating a bubble and having it break is utterly dangerous. In fact, there has never been a Great Depression, a very severe recession that was not preceded by an asset bubble in the entire 20th century.
At the peak of the bubbles, a 3-square-mile area in Tokyo was worth more than the entire state of California. But in 1989, the stock market collapsed, followed by real estate. The Japanese economy has experienced deflation and slow growth ever since.
The Japanese are essentially in their economy where they were 17 years ago. They've had 2 decades of going nowhere.
Greenspan had responsibly waved the warning flag, but the markets refused to listen, and instead turned on the messenger.
The financial world drew in its breath in shock and disapproval over the Fed's stepping over the line.
People were saying, have your chairman stay out of our business. Don't talk down the stock market.
So Greenspan, who likes to be liked above almost all other things, gave this up, this idea that the stock market was too high, and instead began to cheer it on.
Greenspan would never again lean against the wind of popular opinion. Greenspan had kept rates so low for so long that he turned an overheated housing market into the greatest credit bubble in history. It would alter the course of the American economy for decades to come.
You know, the way a healthy economy grows is people earn money and they go out and spend it. The way an unhealthy economy grows is people borrow money and they go out and spend it. The U.S. in 03, 04, 05, 06 was phantom recovery. It was all borrowed money.
So instead of building factories that produce income, we wind up building condos that really don't produce anything. And then we build too many condos. So this great moderation has only been keeping the economy going, keeping the economy going, keeping the economy going, at the same time as making it less and less productive, until there was not enough income supporting that debt. And it implodes on itself.
Shit. Oh, hell, let's just do what we always do. Hijack some nuclear weapons and hold the world hostage. Yeah?
We're talking about the dangers of deflation, why we didn't want to wind up like Japan, and what we might have to do to avoid that.
Ben Bernanke, the professor who had just been hired by the Fed, said, we're not going to let prices fall. We are going to create enough dollar bills to lift the prices of everything by a little.
So because of this fear of deflation, we didn't have a deflation. The Fed continued to follow an expansionary policy.
And the Fed proceeded to press down this rate of interest it controls, the so-called federal funds rate, all the way down to 1%. You could scarcely see it was so tiny.
I really think that was looking at the wrong thing, but all of that led to, as you know, a big boom and a big bust.
If you allow interest rates to remain unusually low for a long period of time, you are creating the environment in which a bubble or in which a rapid credit expansion can occur.
Deep down, monetary policy screws around with our heads, and it influences the amount of risk you and I are prepared to take.
And this is where the real egregiousness in interest rates manifests itself.
The Federal Reserve's main policy interest rate was only 1%. Now the inflation rate was more like 2%.
We had negative, real 2-year interest rates. That means that to borrow money for 2 years is free. Now, this is a problem.
The big banks lend that money out on a mortgage at 5 or 6%. Now, if I can borrow money at 1% and lend it out at 6%, I'm going to make a tremendous profit from that. That was the problem with the low interest rates. Financial institutions borrowed too much, became careless in the lending they did.
Able to borrow money for nothing and earn huge fees for lending it out, Wall Street began simply giving money away.
You know, firms like Lehman Brothers borrowed at those low interest rates, made mortgage-backed securities on the base of it, and spread it around the world.
President Bush signed a housing bill, which was part of his ownership society, and he said how good it was that people had houses.
New home construction, the highest in almost 20 years. Home ownership rates, the highest ever.
But they didn't have any investment in the house. They didn't have any equity in the house. So what did they own? They didn't own anything. They owned a mortgage, which if things got bad, they could default, and they did.
The Fed could have cut off his speculation quite easily, but the atmosphere in Washington then was quite the opposite.
We have an excessive concern about home ownership and its role in the economy. This is not the dot-com situation. Homes that are occupied may see an ebb and flow in the price, but you're not going to see the collapse that you see when people talk about a bubble.
To set standards for mortgages would have been going straight against the political environment. The Federal Reserve would have been pretty brave. They should have, in retrospect.
Despite being the only agency charged with protecting the financial system, the Fed remained on the sidelines.
One of a president's most important appointments is chairman of the Federal Reserve.
My first priority will be to maintain continuity with the policies and policy strategies established during the Greenspan years.
As a Fed governor, Ben Bernanke had spent the peak years of the housing bubble promoting his mentor's easy money and lax regulation. Taking over the helm, he had no idea he would reap what he'd sown.
You have what degree of confidence in your ability to control this?
100%.
There ought to be a greater degree of humility.
I'm one of the baddest motherfuckers of all time. One of the best singers and one of the best looking motherfuckers you've ever seen. Hold my drink, bitch.
So you have to understand, academic economists live in an island unto themselves.
These were people trained in mathematics, not trained in markets. And trying to apply the mathematics to markets, and to human emotion, basically, they stumbled.
In the academic models used by the Fed, debt is not a source of danger. In fact, in most of these models, debt isn't even there. In the academic models, the financial sector isn't even there. So if it wasn't there, it couldn't do any harm. And because their intellectual framework didn't allow for a big crisis to happen, there were no efforts made to prevent the crisis, When they got into it, the whole idea was that we'd soon be out of it.
Bernanke is the perfect academic. He's not looking at house prices. He so profoundly believes in market efficiency that there can't possibly be a housing bubble, so why bother to look for it?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis.
I've been a frickin' evil doctor for 30 frickin' years, okay? Cut me some frickin' slack.
Bernanke single-handedly stopped the run. But when his bailout failed to jumpstart recovery, the Fed upped the ante. With interest rates already at zero, the Fed's only way to juice the economy was to print more money, with a technique called quantitative easing, or QE. Beginning in 2009, the Fed purchased over $1.3 trillion of mortgages and debt from failed lenders Fannie Mae and Freddie Mac. It was a temporary nationalization of the mortgage market. What followed was the single biggest stock rally since 1932. And when markets faltered in 2010, the Fed announced a second round, QE2. If the Greenspan put had been whispered, the Bernanke put was now loud and clear.
So here you have a group that instigates movements in asset prices to get the economy going.
The problem, the subprime market, seems likely to be contained. The global economy continues to be strong. Supported by solid economic growth abroad, U.S. exports should expand further in coming quarters. Overall, the U.S. economy appears likely to expand at a moderate pace over the second half of 2007, with growth then strengthening a bit in 2008 to a rate close to the economy's underlying trend.
I listened to you read the first several pages of your testimony describing the conditions in the financial markets, in particular the swollen non-conforming mortgage portfolios, the lack of investor confidence in the valuation of their investments, then the lack of confidence in institutions holding those assets, a long litany of fairly distinct and unique problems. Doesn't appear to be your garden variety business cycle recession of the kind we were used to in the years after the end of the last war.
Well, again, we're not forecasting recession, but rather at this point slow growth. But you're absolutely correct, Mr. Chairman, that there are a number of characteristics of this period that are...
Many economists, one coming this afternoon from Brookings, who says that there is a recession. Are we in a recession
We
now?
are in a serious slowdown in the economy, which has very significant consequences for the public, and whether it's called a recession or not is of no consequence. The Federal Reserve has a dual mandate for monetary policy. Maximum employment, which means economic growth, job creation, that's one part of the dual mandate. The other part, price stability, means low inflation, keeping the value of the currency more or less stable. Those both very important.
What's going on right now is the most profound coordinated effort in the history of mankind to really promote the financial markets, promote risky assets, give the drunk another drink.
What the Fed is doing is we push investors into other kinds of investments like the stock market.
Bernanke still insists that money poured into a broken financial system will trickle down to the real economy.
And I care about Wall Street for one reason and one reason only, because what happens on Wall Street matters to Main Street.
But can a problem created by money for nothing really be solved by ever more of the same?
Understanding and the media advanced a lot of very uninformed views on this subject. So, for example, if you went back a few years and you listened to media, congressmen, a variety of people, they would say that the Fed's asset purchases will cause hyperinflation, will cause the dollar to collapse, will cause energy spikes, will cause financial bubbles and bursts and collapses. None of that has happened. What has happened is that those policies, maybe they weren't by themselves sufficient, but they were helpful. They helped our economy recover. Our economy is, even if it's not, certainly not perfect, but it's certainly made a lot of progress, and monetary policy has helped there. And many, if not all, of the things that people were afraid of, or some people were, I think informed people were not so afraid of it, have obviously just not come to pass. I mean, that's simply a fact.
It's very good you allow Rita to eat with you in the same place.